So take out your notes on back duty and income tax investigation. So what do we mean by back duty? Now, back duty is a term used to refer to the assessment and correction of taxes in arrears. Yeah, when someone is under tax investigation, it's not necessarily that that it'll take for that period. They can also backdate them, for example, for the last 5 years. That's the maximum they can go. So tax arrears may arise due to the following circumstances. And most of the tax investigation they are done when the revenue authority, they have suspicion that you have not been declaring the correct tax income, or there is some taxes you have not paid or have been evading tax. So saying that back duty is a term used to refer to the assessment and correction of taxes in arrears. Now, tax arrears may arise under the following circumstances. Number one, non-declaration of income. There is income you earned, but you never declared. Then number two, overstating the expenses. You know what happens when you overstate the expenses? You overstate the expenses, that means your income the taxable income will reduce. And if the taxable income reduces, that means you pay less tax. Also, number three, under declaration of income, here you declare, but not the actual amount. And then also claiming relief and expenses, which one is not entitled to. Now, the objective of tax investigation is to establish whether, number one, there was a gross negligence on the part of taxpayer. And then number two, where there's a fraud on the part of the taxpayer. Yeah, so what are some of the sources of information that the commissioner can lie when it's meeting the tax liability? When you're a tax investigation, we have various methods that the commissioner or the tax investigative department, they can use to gather that information. Where do they get this information? Number one, the taxpayer making confession and disclosure. That one cannot happen in Africa. Though it can happen. Yeah, you know, there is some question you can be asked. In the process of answering them, you crucify yourself. Yeah, making disclosure. But that was not your intention. It's only that they ask some question. You know, they have their investigative techniques. Yeah. Then number two, also informer from the income tax investigation department. Yeah, sometimes they act as a customer, as a friend, as a business partner. Then from there, they gather information. Also another one, the media. Another one is the government corporation and department, such as what? Are those government departments? Yeah. Okay, this is the key. Yeah, what about EACC? EACC or EAC? EACC, Yeah, for them, they are concerned. Yeah, ethics and anti-corruption. Yeah, so whenever you understand something, there is actually a lot of investigation they usually do. What about the asset recovery unit? Yeah, they look at the flow of the assets, the flow of cash flow, then start investigating. They even link up to your KRI PIN. Have you been paying tax? No, they inform another department. Then that department, another department. Yeah, that's what happens. Also, another one is the use of PIN number. Also, other business partners. Yeah, your business partner also can crucify you. Also, customer and suppliers. Taxpayer lifestyle. That's why they conduct lifestyle audit. Yeah, you are employed somewhere, you're earning 20,000, but how you are living? No, there is no correlation. There is no correlation. Yeah. And then also your friends can crucify you, as well as when they become enemies, as well as your relative, if you don't support them, right? So how do we determine the income? Now, an determination of income, actually is also the formula that is used to determine the net worth. When you hear that someone is, for example, when there was a time politician, they were declaring their wealth, how do they determine their wealth? That I'm worth this. When someone is worth, for example, 100 million, what does it entail? What formula do they use? Now, this is how they determine the income. So they look at determination. Income. That's on an individual basis. And then what happens? Whenever you're at a tax investigation or when you're declaring your wealth, you don't just take the personal asset you own. No. If you have a company, the company's assets and liability, your personal assets and liability, they will be combined. So, and they use the normal formula. How do we get capital? It's asset minus liability, of which capital is the same as net asset. And your net asset becomes your net worth. Yeah, when someone is worth 100 million, that one does not necessarily mean that your total asset is 100. No, it's asset minus liability. That's how you determine the net worth of a person. So in this case, when determining now the income of a person, this is how they determine. First of all, they'll take all the assets of an individual, be it private or for the business, then you raise liabilities. All the liability for the business and for the private assets. Then, and that's why whenever there is a scandal and someone is being linked, they usually disclose that that company is owned by someone. If it's a politician, it will be called by the parliament to be asked. But you see in company law, you see that there is a separate legal identity between a company and the person. But whenever someone is at a tax investigation, that does not apply. If it was organization, you're one of the director, it will be answerable. So that's how they determine the net worth. Assets minus liability, and that's how now you get the capital or the net worth. Once they determine the net worth, they're saying that in this case, it's all about back duty. They are comparing some years. For example, 2020, 2021, 2022. Once you determine the capital, then you determine the growth from one period to another. For example, in 2020, let's assume your net asset was 80 million. In 2021, it was 90 million. That means within 1 year, you generated a wealth of 10 million. This 10 million, how much do you pay as tax? So that's what for the tax department they are concerned about. So you determine the growth, that's the fourth step. Once you determine the growth or the changes, that one becomes to be your income. That one becomes to be your income. And that's what now they assess to determine whether you filed the correct tax. Yeah. So now let's look at determination of income. This uses the principle of capital computation. And to determine the individual capital or wealth, one requires to apply the accounting equation. That is capital, you take the assets minus liability. A capital statement is used in estimating the taxable income, and it shall be prepared as follows. That applies to an individual. One, you ascertain all the assets of the taxpayer, whether private or for business, or the assets. Then number two, you ascertain all liabilities of the taxpayer, whether private or personal, or business. Then number three, you determine the net capital or wealth of the person by determining the difference between step one and step two. That's the asset minus liability. Then number four, you compute the growth of the net worth by comparing the net worth at the beginning of the period and at the end of the period. Now that growth will be regarded now as your income. Can you write in bracket income? Yeah, step number 4 in bracket is your income. Then number 5, once you determine now your income, now you do some adjustment to your income. You add all desirable deductions such as living and personal expenses, including drawings. If you have taken some goods from your business, some cash from the business is regarded as part of the drawing. So you add back all the desirable expenses such as living expenses, personal expenses, including any forms of drawings. Then you raise, you deduct non-taxable incomes. Yeah, non-taxable income, such as what? Inheritance. Maybe you had inherited something from maybe your parent. Yeah, so in that case, you eliminate. Also, you're saying that you eliminate non-taxable income and income whose withholding tax is final. Right in bracket, which are those incomes which withholding tax is final? Interest, and dividend from companies, and dividends from companies. Yeah, but if you received any dividend from the circle or cooperatives, those are what we call non-qualifying dividends. So that one, withholding tax is 15%, which is not final. So in this case, we are only deducting the income, the non-taxable income, and incomes whose withholding tax is final, such as interest, as well as dividend from companies. Then number 7, you deduct allowable expenses never deducted, e.g. capital allowances, correct? E.g. capital allowances and mortgage interest. Capital allowances and mortgage interest with a restricted amount, of 300,000 per annum. Yeah, mortgage used to be 150. The maximum amount you can claim for mortgage, or any private asset. I mean, for mortgage asset. So, if you are paying an interest of, for example, 400,000, you cannot claim the 400. The maximum you can claim is 300. 300. Good. So now take out your past paper. Open with me. June 2011, question 3B. June 2011, question 3B. June 2011, question 3B. You can also use your notes. I've already indicated the question there. You can also use your notes. So you're told that Makosa Maingi has not been maintaining proper books of account since the inception of the business in the year 2007. The following balances were obtained from the available business record for the 4-year period ended that 1st of December 2010. So we have all that. Then you are told that capital allowance were agreed at the total of 76,000 for the 4-year period. You see, but duty is all about past years. When you have an investigation, they don't just investigate 1 year. So in this case, they are conducting an investigation for the last 4 years. Required. Estimate the accumulated taxable income of Makosa Maingi for the 4-year period ended that 1st of December 2010. So how do you determine that? You prepare the capital statement. So Makosa Maingi capital statement for the year. So here we had 207, 208, 209, 2010. So you say that. How do you determine the taxable income? Step number one, you'll take the total asset, both private and the business. Then you raise total liabilities, private and for business, and that's how you get the net. Once you get the net worth, now you determine the income. How do you get the income? Get the income, the growth in net worth. Now that growth will be now be regarded as your income. Now, once you get the income, you adjust by adding back any disallowable expenses and including drawings. Then you deduct any non-taxable income, and whose withholding tax is final. And then you can also raise any allowable expenses never deducted, such as capital allowance. So let's go to year 207. Now, can you add all the total assets? Add all the assets. I'm sure you know what's an asset, what's a liability. Just add the total assets. How much are you getting as the total assets? Yeah, should be 16 to 80. Yeah, so now let's read them. So leasehold property, it's an asset. Motor vehicle, it's an asset. Furniture is an asset. Bank overdraft is a liability. Loss on sale of investment, that's an expense. So it affects the income statement. And loss on sale of investment, that one becomes a disallowable expense. Yeah, because again, disposal of an asset is not taxable, it's an untaxable income. So therefore, if you dispose it at a loss, that it will not be allowable. Then data is an asset. Mortgage loan, it's a liability. Stock, it's an asset. Computer, it's an asset. Bank account is an asset. Foreign exchange losses, that's an expense which is allowable. Good. So that's how we determine the assets and the liability. Now, can you add the total liabilities for 207? Add the total liabilities for 27. You get an amount of 1140. Good. So therefore, you get 15,140. And that's how you get the net worth. Now, once you get the net worth, now we want to determine, in this case, we are not concerned about the net worth. We want to determine the taxable income. Now, 207 will be dashed. From 207 to 208, from 15,140 to 11,708. Did we have increase or reduced? Hey, can the rest be here? This is what we are solving, eh? From 15 to 11,708. That's a reduction by how much? That's 4? That's 2. That's a loss. From 11,708 to 18,932. That's an increase. So there was an income, an amount of how much? $72.24. From 18,932 to 16, that's a reduction. A reduction by how much? 27.82. So that's the growth in net worth, which will be regarded as an income. Now, once you get the income, then you can add any disallowable expenses, such as living and personal expenses. Now, in their financial statement, there is something they had recorded: loss on sale of investment. That's a disallowable expense. So you add back loss on sale of investment. So it was 208, an amount of 84. Also in 2010, an amount of 17. Then you raise any non-taxable income, we didn't have any. Also, you raise allowable expenses never deducted. So first of all, Give me now the taxable income. What about this? You get 33. You just take this, the income, then you adjust. Okay, give me this then. So this one you get that 348, which is negative, and this one you get an amount of 2612, which is a negative. So we get the total taxable income. Now add for me for the 3 years. You have 1264. Then you can less. So you're told that capital allowances were agreed at a total of 76 for the 4-year period, not for each year. If it was for each year, you could have adjusted for each year. But in this case, we are told that for the 4 years, the total were agreed at 76. So you net it against now the total taxable income. So you raise the capital allowance, which is an amount of 76. That's how you get the adjusted taxable income. You get an amount of how much? 11? Good. So that's how you determine the taxable income. And that's for another one. Open with me November 2015, question 5C. November 2015, question 5C. November 2015, question 5C. So you're told that Amos Akinda, a businessman, is facing tax investigation by the Revenue Authority, which suspect that he has been under declaring income for the 4 years from the year 2011 to year 2014. You are the head of the team from the Revenue Authority conducting an investigation of Amos Akinda. He has submitted to your team record of his private and business assets and liability from 1st of January 2011 to that 1st of December 2014 as shown below. So you have all that. Additional information. Number 1. The cash balance on that 1st of December 2012 includes 600 inherited from a relative on 30th of August 2012. Number 2, his living expenses for each of the 4 years were as follows. So are given the living expenses from 2011 to 2014. Number 3, interest on mortgage is at the rate of 15% per annum. And then there was no disposal of non-current assets during the period under investigation. Required. Taxable income of Amos Akinda for each of the 4 years ended that 1st December 2011 to 2014. You ignore capital allowances. 2011 at the beginning. Now, can you add for me the total assets? Add for me the total assets. How much is the total asset? 104? 104, 190. This one will be 122. 740. I have 138. 840. I have 132. 890. I have 140. 340. Also add for me the total liabilities for 2011. How much your total liabilities? So now let's see those assets and liability. You can see others are still steering. We have factory premises, that's an asset. Planted machinery, it's an asset. A motor vehicle, it's an asset. Inventory, it's an asset. Trade receivable, it's an asset. Private resident is an asset. Trade payable, it's a liability. Bank loan, it's a liability. Loan from a friend is a liability. Mortgage loan is a liability. Cash balance, it's an asset. Good. So now let's get the net asset. Can get the net asset. What do you have here? So here you get 81. For that, you get 95,080. You get 111. 530. Get 108. 710. You get 114 to 10. So that's the net asset or the wealth, the net wealth. So now let's determine the growth. So at the beginning of 2011 is dash. Now wealth grew from 81,430 to 95,080. An increase by how much? Sorry? 13,650. From 95,080 to 111,530. 16? 16,450. From 111 to 108, that's a reduction. 2820, that's a negative. 108 to 114, that's an increase. What? 5,500. That's how you determine the growth in net asset, which will be regarded now as our income. Then we add, once you get the income, you add disallowable expenses, such as living expenses. Yeah, so in that case, note number two, you're told that his living expenses for each of the 4 years was follows. So we have living expenses. Year 2011 was an amount of 85. Here we had an amount of 140, 90, 165. And we add back all the disallowable expenses. Then you raise non-taxable income. For non-taxable income, there was inheritance. They have been told that, note number one, the balance, the cash balance on that 1st October 2012 includes 600 inherited from a relative on 30th of August 2012. So 600 2012. So that means in these assets, when determining the total asset for the cash, there is an amount of 600 which was already included. So you will remove it. Then you also raise allowable expenses never deducted, such as mortgage interest. Mortgage interest. So we have the mortgage. How much was the value of the mortgage? How much was the value of the mortgage? That 780. So it's that 780 at the rate of 15%. So 15% of that 780 is an amount of 560. Yeah, 567. Correct. But you see that for the mortgage interest will be restricted to a maximum of 300. Yeah, that's the maximum you can claim. Eh? So from your notes, you'll change that. Can you go back to your notes? From your notes, it's 150. It used to be 150 or 12,500 per month, but now has been increased to 25,000. But from your notes, you can change that. But the mortgage interest should be around at 300. And that's how we determine the taxable income. Now let's determine that for each year. This one is 13,485. 435. 15,690. Sorry? That. And that's how we determine that. So you can look at that for 1 minute. November 2017, question 4B. Peter Chawawa started a retail business on 1st of January 2011. He has not been filing income tax return for the 6 years to that 1st of December 2016. An investigation to his affairs revealed the following. So the balance sheet on the retail business as of that 1st of December 2011 was shown below. So we're given the assets, there was premises, furniture and fittings. There was also motor vehicle. Current assets, we have stock, we have debtors, we have bank balance. Then we have cash in hand. Then we have the total assets. Then we have the capital, the net profit for the year, drawings, mortgage loan. Then we have creditors. Number 2, he constructed an extension to the premises in the year 2015 at a cost of 625,000. Yeah, that's a capital expenditure. Cost to extend, that's a capital expenditure you need to capitalize to the cost of that asset, to the value of that asset. Number 3, the following account balances outstanding in the respective years are shown below. Number 4, withdrew goods worth 5,000 per annum from the business for his personal use. Number 5, the principal repayment of each mortgage loan amounted to 50,000 per annum from that 1st of December 2012. The mortgage interest paid in each of the 4 years ended that 1st December 2012, 13, 14, and 15 amounted to 175, 50, and 25 respectively. His wife opened a saving account in the commercial bank in the year 2012. Yeah, also your wife. Wealth will be considered to be your wealth. Yeah, his wife opened a savings account in a commercial bank in the year 2012. The balance in his account after crediting the interest earned was as follows. So we have the savings account amount. Then we have the interest earned. Number 7, his living expenses and wear and tear allowances were agreed with the Revenue Authority as follows. Required. Compute the annual taxable income of Peter Chawawa from the year 2012 to 2016. So now let's start with the assets. Now for the asset, in this case, we have to determine individually. So from the balance sheet, we have premises. How much was the value of the premises? Yeah, premises was 2,000. 2,000. 2,000. 2,000. 2,000. Let's go to note number 1. Sorry, number 2, note number 2. He constructed an extension to the premises in the year 2015 at a cost of 625. That was an non-current asset. Then there was furniture and fittings. You take its real value and then you claim wear and tear later. 100,000. Then we also had motor vehicle. Of 500. Then we go to the current assets. The current assets, we have stock. Stock, we had an amount of 250, but these are current assets. That means they keep on changing in every year. Note number 3, the following account balances outstanding in the respective years are shown below. So stock for 2012 was an amount of 255. Here we had an amount of 302.5 and 332.5. We have 366, and then we have 42.5. We also had debtors. 2011 was an amount of 160. Note number 3, for 2012 was an amount of 173. We also had 190, 28, 30.5, and then 253. Then there was bank balance. Bank balance, we had an amount of 81. Then note number 3, we have 109, 194. Yeah, 194, we have 281. We have 49.5. And then we had 32. It's negative. Then there was cash in hand. For the cash in hand, 2011 we had 9. And then we have 10, 10, 10, 10, 10. And then note number 6, his wife opened a savings account in commercial bank in the year 2012. A savings account is part of cash and cash equivalent. Savings account he opened in 2012. And the savings account here we have is 300. We have 900. We have 100. 725. Then 750. I think we have all the assets. So give me the total assets. And kindly, can you distribute that? Don't just wait for the others to compute for you. And you know how to use a calculator. Hatujamalizana na swali, tutakuja huko Interest has never been an asset. Yes. Interest affect the income statement. 2016. 0.5. 2011 it's 4,000. Yes. 2012. 347. 50. Sorry? 1.5. Then we deduct the liabilities. For liabilities, we had mortgage loan. So mortgage loan, we had an amount of 1,000. Note number 5. The principal repayment on each mortgage loan amounted to 250 per annum from that 1st of December 2012. 250. So the balance will be 750, 500, 250, dash dash. Then we have creditors. Creditors, we had an amount of 200. Then note number 3, we have the other creditors. We have 230. We have 241. We have 253. We have 272. And we have 291.5. Good. And then did we have any other liability? I don't think we had any other liability. So now give me the total liabilities. So now let's get the net assets or the net wealth. So to get the net assets, so you can call the total asset A, total liabilities B. So to get the net asset, you take A minus B. Sorry? 2800. 2014? 2014? 28.5. Sorry? 3367. 17. 4355.5. 55. 94. So once we have the net asset, yes. Sorry, you're supposed to take 570. I think it's okay the way it is. Yeah, just look, just check. So you can see our figures are in thousand, right? And then you're paying how much per year? I think it's okay the way it is. Just check. All the figures are in thousand. Yeah. Are you okay? Yeah. So now let's determine the growth in net asset. And that will be regarded as our income. So that's dash. From 28 to that 3, you have 567. That 367 to 4355.5. 988.5. 4355.5 to that 9. That's a reduction. Sorry? 127. 427. From that 9 to 55. 5.5. 5594 to 5217. Sorry? 77. So now we have our growth in net asset, which will be regarded as our income. Then from there, we can add non-taxable income. So not non-taxable, but disallowable expenses, including drawings. Let's start with the drawings. Yeah, we say that you add back disallowable expenses such as living expenses, personal expenses, including drawings. Note number 2 here to that. He withdrew goods worth 5,000 per annum from the business for the personal use. So 5, 5, 5, 5, 5. Then you also add the personal expenses. Let's go to note number 7. His living expenses and wear and tear. So there was living expenses. That's from 2012. 300, 400, 450, 500, and 600. I think that's what we have for the desirable expenses. Then you raise non-taxable income and incomes whose withholding tax is final, such as interest. So in this case, we didn't have inheritance, but we have interest. Income whose withholding tax is final. So we have interest, income, for the wife. Note that note number 6. His wife opened savings account on commercial bank in year 2012. The balances in his account after crediting the interest and was followed. So that means when you're determining these savings, they have already included the interest. So we eliminate that interest because the withholding tax is final. So to only be taxed at the source. So the interest for 2012, now included in this, was 25. Here we had 75. Here we had 90. Here we had 70. Here we have 60. Also, you raise allowable expenses never deducted, such as wear and tear. Wear and tear. For wear and tear, note number 7, 2012, 155.5. Also, here we had 130.5. We had 109. Also, there was 73. And then there was 157. You also raise other allowable expenses such as mortgage interest. Mortgage interest, but now with a restriction of 300,000 per annum. And note number 5. The principal repayment of each mortgage loan amounted to 50,000 per annum from that 1st of December 2012. The mortgage interest paid in each of the 4 years ended that 1st December 2012, 13, 14, 15 amounted to 100. So from 2012 was an amount of 100. 2013, 75, 50, and lastly, you paid an amount of 25. And that's how you get now your taxable incomes. I think we have factored everything. Good. So can look at that for a few minutes. Yes? Sorry? 2011. There was no drawing in 2011. You see, now let's be here. When you're determining the income, 2011, the net worth we had of 28, so you're to determine the growth. That's when December for the first period is always a dash. Once you get the growth net worth, so you only adjust for the other years. If there is nothing, you'll be adjusting here. So the first period is always used to be used as PO. The word at the beginning, at the end. Then you look at the change for the year from there. Because you see, if you have to add back 5 here and others, but you see there was no income. Yeah, because we just determined the growth. Even if you look at the question we did previously, there was 2011, another 2011, but this was January, this was December. So once you get the net worth, the first period is always a dash. The growth now you determine at the end. Yes. And then, after all, it's the same thing. Yeah, this bank over there, it's not a must that you have put it here. So usually it's a negative. Yeah, it's a cash balance, but it's a negative. Good. So we take a small break and then we come and look at anti-avoidance measures. Anti-avoidance measures. So now let's look at anti-avoidance measures. Yeah, we have what we call the tax evasion and we have the tax avoidance. The two are totally different. Now, tax avoidance, it's a legal way of minimizing your tax liability, while tax evasion is illegal way of not paying the correct tax. Yeah, so we're looking at anti-avoidance measure. So tax avoidance is more of the tax planning, where you try to do all the means to minimize your tax liability, but not conflicting with the rule. But for tax evasion, it's an illegal thing. It's a fraud. It's part of it's a kind of fraud where you fail to pay the correct tax liability or you fail to pay at all. They are two totally different. So now, if tax avoidance is illegal, that means a company and entity can exercise that, minimizing your tax liability. Well, the government gets some revenue. If you do all the best you can to cut on your costs. So how will the government get some revenue? So in that case, they came up with some measures to try to curb that, so that at least they can be able to draw as maximum tax they can get mostly from the company. And that's what we call the anti-government anti-avoidance measure. All the measures taken to minimize the tax liability by legal means. Now, these are rules introduced by the tax authority to combat the avoidance of tax. So what is tax avoidance? It's a deliberate legal measure. Can you underline the word legal? Yeah, it's a deliberate legal measure taken by the taxpayer to minimize tax liability. In this case, the taxpayer does not conflict with the law, and the taxpayer uses exemption under the law and does not challenge the legality of the tax law. Then we have tax evasion on the other hand, and this is an illegal activity. Can you underline that illegal? Yeah, it's an illegal activity in which the person of the taxpayer deliberately avoids paying the true tax liability. Then you have what you call the tax resistance, like what you are facing currently. You fail to pay the tax because you don't like the government, or because you are opposing a given project to be undertaken by the government. That's what we call the tax resistance. Yeah, we're saying that it's a deliberate refusal to pay tax, either because of one conscience, for instance, because the taxpayer does not want to support the government or some of the activities because he feels strongly against such activities. So now let's look at anti-avoidance measures, and they are measures that prevent the tax reduction or reduction of tax liability by legal arrangement. They include, so there are three. One, we have shortfall distribution of dividends regulation. Then number two, we have what we call the compensate the capitalization rule. The capitalization rule. And then number three, we have compensating tax measures. Those are the three major anti-avoidance measures. Now let's start with the first one, the shortfall distribution of dividends. Now, companies are required to make the following distribution to the shareholders in form of dividend. Yeah, you see, if the company makes a profit, for example, of 100 million, and then they decide to pay 20% of the retained of the profit as dividend. So that means they pay 20 million. But now remember, when the company is paying dividend, they need to charge some tax at the source. That's what we call the withholding tax. So the rest tax they pay, the rest withholding tax they pay. So the government came up with measures to minimize this. And the government came up with measures that of the profit after tax, of the total profit for the year, the company should distribute at least 40% of the profit after tax from the operating profit of the operating profit to the shareholders. And then in case there was any other non-operating income, such as investment income, rental income, you distribute everything to the shareholders. 100% of non-operating profit. So that means you pay more dividends to the shareholders. Since once you distribute to them, the government will get more tax in form of withholding tax. So what are those measures? So you're saying that companies are required to make the foreign distribution to the shareholders in form of dividends. Number one, at least 40% of the operating profit after tax. Number B, 100% of non-operating profit after tax. Now, companies may be exempted from such requirement in the following circumstances. Now, what are those circumstances of which now they're exempted from that? Number one, if the companies that are taking a capital project. Number two, when the company is servicing a loan. The company is servicing a loan. But that nowadays they don't consider, because most of the company, they used to have a debt in the capital structure. In case it's a levered farm, that means you not pay. So nowadays that one is not applicable. Then where the company is controlled by the government, directly or indirectly. Yeah, that means where the company has some shares or have some stake, it's not a must they distribute that. They're exempted from that regulation. Then number four, when the company is in the process of merger as a predator. Whenever the company is in the process of merger and acquisition, as a predator, there is a lot of tax incentive for them. And then number five, when the company has no liquid funds. And when the company has no liquid funds, that means the company can be profitable, but all the cash are still outstanding, they are unrealized. So in that case, you have nothing you can pay to the shareholders. So in that case, the company will be exempted. Now, if the company does not comply with this requirement, a shortfall distribution tax or a penalty of 5% is imposed on the undistributed profit. Can you cancel that? Can you underline that? 5% of undistributed profit. 5% of undistributed profit. Yeah, you see, for a company, the withholding tax is at the rate of 5%. Kwa hivyo ukilipa kidogo, ingine haujalipa, serikali inakujia tax yake hiyo 5% yenye ungeheld kama ungecomply with this regulation of paying the full dividends. Now let's do an illustration. December 2011, question 5A. December 2011, question 5A. December 2011, question 5A. The following information related to Maji Mazuri Limited for the year ended that 1st of December 2010. So there is profit before tax, 100. This comprises of investment income of 10 million and operating income of 90 million. So the profit before tax, the profit before tax was 100 million, which comprised 90 million from operating activities and 10 million was from investment income. Let's say that again. That profit before tax was 100. This comprised investment income of 10 million. Remember, investment income is not an operating income. So that's an operating income. It's among the specified sources of income, and operating income of 90. Number two, the balance of long-term loan was 50 million. I remember interest on debt is a allowable expense. Yeah, the balance of long-term loan was 50 million shillings with an interest rate of 10% per annum. That means they're supposed to claim an interest of how much? 10% of 50, you get an amount of 5 million. Only 40% of the interest on the loan due for the year was charged in determining the profit for the year, being the actual amount paid. So that means the interest on loan it's 10% of 50 million. That means to the income statement, they are supposed to claim all the 5 million as allowable expense. But they only paid 40% of what they paid. That's what they charge to the income statement. So that means there is an item they never charged. So you raise, this was the profit before tax. In determining the operating profit, they were supposed to deduct an interest of 5 million, but they only deducted 40%, being the actual tax paid. You don't charge what you paid. You don't claim what you paid. You claim what you incurred during the year. Use the accrual basis. You raise interest on loan. So it's 10% of 50, of which you get an amount of 5. But when determining this profit, they deducted only 40%. So that means they are charged by 16%. An amount of how much? 60%, you get 3. And that's an operating expense. And then number 3, capital allowances. Yes, you know capital allowance is allowable expense, right? Yeah, so capital allowance is allowable expense. Capital allowances provided for in the income statement amounted to 4 million. Yeah, so they deducted 4 million in the income statement. However, the Revenue Authority has revised this amount downward to 2. You had claimed wear and tear of 4 million, but the Revenue Authority, they are telling you no. You're only supposed to claim how much? 2. So what do you adjust that? You add back overcharged capital allowance. You are supposed to claim 2, but you claimed 4. So in short, in determining this taxable profit, you are deducted 4, but you know that you're only supposed to deduct 2. So you add back 2. Number 4, the total dividend paid for the year amounted to 25 million. And the company is subject to corporate tax at the rate of 30%. Required shortfall distribution tax for the year. So first of all, now let's get the taxable profit. Taxable profit, you get 89. Here you get 10. Then you raise tax. The total is at the rate of 30%. Here you get 3. $26.7. So how much will be the profit after tax? $62. So that's the profit after tax. Then we have minimum distribution. Minimum distribution. We say that from the operating income, they should distribute a minimum of 40%. From non-operating income, they should distribute 100% of the profit after tax. So that means here they should distribute 7 million. What about this? $24.92. Yeah. So that means the total dividend payable or minimum dividend payable, they should 24.92 plus 7, they should distribute an amount of 30.92. Then you compare against actual dividend paid. Actual dividend paid. And you are told that in note number 4, the total dividend paid for the year amounted to 25. They only paid 25. So therefore, there is shortfall distribution. Shortfall distribution. An amount of how much? 6.92. So how much will be the shortfall tax? We charge 5% of 6.9. Sorry? 346, which is equivalent to 346. That means if you could have complied with the rules, the government could have recovered the withholding tax of 346 on top of that, on what you had distributed, on what we have withheld. Yeah. So in this case, the 5% of the dividend you never distributed, now the government will come for their tax in that scenario. Good. Good. So open with me, May 2012, question 4B. May 2012, question 4B. At one, you're told that justify the imposition of shortfall tax on company. You justify the imposition. Actually, that's what I was trying to explain here. Okay. Why do the company impose that shortfall distribution of tax? So that in order to recover the tax that they could recover, they could have earned as a result of withholding tax if the company could have paid the total dividends. That's how you justify. And then you can also explain further on that, that the company should distribute a minimum of 40% from the profit after tax and 100% of the profit after tax as dividends. But also you can also say that the company might be exempted from the above regulation due to, you show that. But the major to justify is try to say, why do you charge that at 5%? It's in order to recover the withholding tax that could have been recovered or could have been earned if the company could have distributed all the dividend required. Part B of the question. Part B of the question. In the year ended that 1st December 2010, Maripo Limited earned a profit before tax of 400 million from the main operation. A main operation, that means from operating activities. So we have what we call the operating activities, and we have non-operating activities. So we are told that in the year ended that 1st of December 2011, Maripo Limited earned a profit before tax of 400 million from its main operation. So the profit before tax was 400. In addition, the company earned an investment income of 60 million. Investment income is not an operating income, it's an operating income. They earn an amount of 60. Then you are told that dividend paid to members for the year amounted to 98 million. The corporate tax rate is 30%. Required shortfall tax payable by the company for the year ended that 1st of December 20. That's very simple. Now, this was the profit after tax. From the operating activities, 400, non-operating, 60. You tax. How much is the tax rate? 30. So you get the profit after tax. You multiply by 0.7 so that you get the profit after tax. Once you get the profit after tax, what we are concerned with is about the dividend they're supposed to distribute. From the operating profit, they should distribute at least 40% of the profit after tax. 40%. But from non-operating activities, they distribute 100%. So give me the dividend payable. $112. Is it 42? Yeah. So minimum distribution, it'll be an amount of, is it 154? Then this minimum they should distribute. Then you compare this against the actual dividends. Actual dividend paid. During the year, they paid a dividend of how much? 98. So there was a shortfall distribution. An amount of 56 million. So they never distributed this 56. So for the government to recover the withholding tax now remaining with the company, that's how they charge the shortfall distribution tax. Shortfall distribution tax of 5%, which is equivalent to the withholding tax of 56. 5.6 divided by 2, you get 2.8, right? 2.8 million. 2.8. Simple as that. So that was all about shortfall distribution of dividend regulation. Good. And then you also have what we call the incapitalization. So any question here? Or do the other one? Can look at that for 1 minute. So let's do the rest in next class. So now we are only remaining now with being capitalization and compensating tax. And then we'll discuss something to do with tax planning and other theories. And then also we'll revise a cut. Yeah, so I'm done with my syllabus once we are done with that.